One of the most important events for the financial market right now is the upcoming U.S. CPI report scheduled for July 15th. Last month's CPI was 2.4%, and the consensus for this release is 2.6%. The CPI matters because it significantly influences the Fed's decision on interest rate cuts. The Fed's target inflation is around 2%. A CPI above 2.6% may lower the chance of a rate cut, while a reading below that could increase the odds. According to the latest market pricing, the probability of a rate cut in the July 30th FOMC meeting is only 7.4%. But for September 17th, the odds are 69%. That means September is the more likely month for the first cut if inflation behaves. One key tool for predicting CPI is the inflation swap market, which is currently pointing to a forecast of 2.65%. Historically, this indicator has shown high accuracy. If CPI comes out between 2.6% and 2.7%, it's likely in line with expectations. But if CPI hits 2.7% or higher, it could push the dollar and bond yields higher, possibly weighing on the stock market. That's because inflation pressure would delay rate cuts. Currently, the S&P 500 is at an all-time high. If CPI meets expectations, the market might stay stable, but any surprise, especially to the upside, could trigger volatility. Also, if the market rises sharply right after the CPI release, even if the numbers aren't impressive, it might just be a short covering or hedging effect, not real investor sentiment. The real market move starts after the open, once traders digest the full context.